The first kind of technical analysis tool that you want to understand is the simple moving averages. So here's a chart of GLD, which is the gold ETF. It's a 1-year daily chart. As you can see, there's lots of ups and downs. It's been in a downtrend, but over the past 2 months or so, gold has been steadily climbing up. Now, this particular bar is concerning for gold because you can see there's a lot of high volume. So first of all, you should always put volume here because volume will tell you a lot of things. And so you can see here on this particular bar, there was a lot of volume that came in. So this tells you that there was a lot of selling on this bar because the volume is just extraordinary and the bar got rejected from the top and ended towards the middle. So this would probably set the tone for gold over the next few weeks. Today it's a little bit up, but regardless, I think the trend should be lower for gold because this particular bar is pretty strong with very, very high volume. Now, let's look at moving averages. So on the Thinkorswim platform, and every platform will have the ability to add these technical analysis tools. On this one, what you want to do is you want to get a simple moving average. By default, it puts a 9 there. And I want to add, let's say we are looking at a 1-year daily chart. And so which means we are looking at a longer term investment here. So I want to add 2 or 3 moving averages so that we get some idea of how to interpret this. So let's then edit this, and I'll say that my first moving average would be a 20-day moving average. So I'll change the 9 to 20. The next one I want is a 50-day moving average. So, and you should change the color. So, and then you want a longer term moving average, which is a 100-day moving average. So let's go and put 100 and give it another color. Let's go take a look. After you add all these, you want to apply and you want to say OK. So as you can see, the 100-day moving average, which is the gray line, is coming down slowly. Then what happened was the 50-day started crossed under the 100-day. So, that's always a bearish sign. When the faster moving average crosses under a slower moving average, that is a bearish sign. The 20-day had crossed under the 50 and the 100. So that itself told you that this was going to be a bearish move. But then the 20 briefly goes up above the 50. But then here the 20 comes down, the 50 is also below the 100 and the 100 is sloping downwards. So here you can see that this is where you have all 3 signals lined up properly, all 3 moving averages lined up properly. And when you see the fastest moving average, which is the 20-day, below all the others, and then you see the next fastest, which is the 50-day, is below the 100-day, and the 100-day itself is sloping downwards. So this tells you that this is a bearish move. And so here, somewhere here, you could have shorted gold, you could have sold gold, either shorted it or bought put options on GLD. And perhaps somewhere here you would have gotten out because here the 20 crosses above the 50. Here, if you're still holding the longer term positions, you can see that the 50 never convincingly crosses the 100. So the bearish tone is still there. It becomes bullish only when the 20 crosses over the 50 and the 100 and the 50 crosses over the 100. So right now, today, the 50 seems to be crossing over the 100, but it's not conclusive yet. And like I said, you got to use various parameters to look at. In this case, I feel that this bar was a very strong sell, and therefore that's going to at least move gold to a sideways trading price action rather than a bullish one. Could go a little bit down as well. Also depends on the markets. See, when the markets are going down, gold is going up. And when the markets are going up, gold is going down. So right now you can see gold is up 16, and that's because the markets are going down. So gold sometimes acts as a safe haven. It gets inversely correlated to the market. So if the S&P is going down, then the gold will go up. So the principle of moving averages is the 5-day goes back 5 days and calculates the average. And then the 10-day goes back 10 days, the 20-day goes back 20 days, and the 100-day will go back 100 days and calculate the average price, and it keeps plotting the average price on every given day and draws a graph. So what does that tell you? It tells you the trend for that particular time frame. So whether it's 5 days or 10 days or 20 days or 100 days, it'll tell you the trend for that particular time frame. So that's how you have to look at moving averages. And now you'll also see some older lectures on various other important technical analysis tools which would be appropriate for a beginner to get started and actually make some trades, perhaps on paper money, but this would actually help you get into trades. Thanks.